Tim Wixon, kia ora, welcome.
Nice to see you.
You wrote a good piece, I thought, about the tech sector in which you compared it to like an epic novel. This is not an industry for the faint of heart.
I have full respect for entrepreneurs, founders, right? Huge amount of risk, personal risk, responsibility, huge dreams, huge opportunity. So it's super interesting from a banker lens, looking at it when you're putting in our version of funding, right? So we go the non-dilutive, don't like uncertainty, like risk kind of context. Founder, super comfortable in uncertainty, right? Super driven. Yeah, amazing.
That tension between, natural aversion to risk versus the untold potential in this sector must be a really delicate balancing act from your point of view.
Yeah, it is, but it's what captures the imagination, right? So as you quite rightly said, there's all sorts of founders, and from a banker perspective, you buy into the dream, buy into the story, buy into what they're trying to achieve. And then you're just trying to help in whichever way you can, right? And help it scale across heaps of companies all around New Zealand. So with all sorts of entrepreneur, founder personalities.
When you think about the tech sector and its place within the New Zealand economy, like the Productivity Commission has talked a lot about this idea of frontier firms, and that New Zealand doesn't have enough frontier firms, big fundament firms off which you can sort of build a sector. Is that how you see the tech sector, or is it more take a great idea, build it up to a certain point, and then flick it off for a lot more, for a lot of money, essentially? What's your perspective on this?
So I think it's both. So I'd love to see more frontier firms by the Productivity Commission's definition. One of the best examples of a large company that's been founded and grown to a huge scale in the New Zealand economy is Xero, right? So huge fintech company, and the things that have flowed from it, it's captured the imagination of NZX, it's captured the imagination of their shareholders, it's captured the imagination of their staff. The capital that's gone through and been returned to shareholders has been reinvested in other companies. And then you look at this burgeoning fintech market, and a lot of it is enabled by what both Xero has done, but also being able to integrate into Xero's business, right? So imagine if there were a whole range of other Xero's, Rocket Lab's probably another example in the aerospace industry, which is, excuse the pun, going to the moon from New Zealand perspective, right? It's just there's a huge amount of opportunity. It's from some stats larger than the wine industry from a GDP contribution already, and those companies create a whole range of founders with the imagination to go and do other things, but also those businesses that surround them. But also there's only so many resources, people, staff available in the New Zealand economy that you can scale to a really large company within New Zealand, right? So even Xero employs a whole range of people offshore, Rocket Lab the same, and some other companies will hit that point where it makes more sense potentially to sell to a strategic buyer or their obvious exit to whoever it may be offshore. And then start and do something else. And we're starting to see that recycling of that talent and capital coming back through the New Zealand market, which is amazing to see, whether it's a frontier firm or some of those companies that have sold a little bit earlier.
I mean, what lessons do we kind of take for the potential of the tech sector in New Zealand from the success of PushPay? Yeah,
it's a great example, right? So it went founded in 2011 or so, became $1 billion company within 10 years, maybe about the fastest in the New Zealand economy. We went on a trade mission up to the US with a range of clients and New Zealand Trade and Enterprise and others about 3 years ago. And one of the main lessons that we learned in the US market and the guidance back to the New Zealand companies that we went up with was, if you want to approach a global market and the US market in particular, you need to be an inch wide and a mile deep, right? So you have to have a super narrow value proposition that really solves a problem, and then know everything about that and be able to solve for your clients. And so PushPay is a great example, right? They were into the donations business for churches, and they stuck to that and scaled, and became a super large company out of New Zealand in that market, versus other companies that might try and be a mile wide and an inch deep and try and do a bit of everything. And it's one of those really interesting lessons. The other one is just the sheer scalability of tech companies. That it's borderless. You can sell from anywhere. It's super high gross profit margin. You can attract investment funds, and I think they were really organised around how they did their capital side as well. And that's one of those things that I think is a huge lesson, right? Capital planning early, thinking about what sources of capital you need to grow as you go. and they've also been open to the both organic style growth and the mergers and acquisitions that they've done in the later years, which they're going through now.
When things do go wrong, I imagine that maybe you see this a bit, or you observe it happening in companies. What are the things that firms do wrong or don't pay enough attention to? What leads to downfall in this area?
Yeah, so that's a great question. All sorts.
Yeah.
The first I'd say is relationship breakdown. So breakdown between founders. See a lot of that, more than I'd like to see. Breakdowns between shareholders, so misalignment. So you've got 3 shareholders, one wants to have dividends, one wants to grow to $1 billion company, the other wants to be in for a medium amount of time and sell out and return their funds. So that's one. Running out of cash is another. So and I think that's a trend that we're seeing at the moment, right? So because the equity markets have been all over the show over the last 6-12 months, mainly down for tech companies, that equity liquidity has slowed down. And what that means is the companies that have been over-reliant on continuing to raise capital from equity markets may be finding that a little bit harder. So again, if you're over-reliant on liquidity raises, maybe that might not be a thematic as you go forward. And certainly we see earlier companies in their earlier stages of life not being able to raise enough capital to achieve what they need to in terms of market penetration or winning, if you like.
That leads us quite neatly really into chatting about revenue-based financing. What is this, and how is it particular to the sort of tech sector?
So we started funding tech companies 8 years ago when that wasn't a thing. So 8 years ago, banking and tech companies definitely didn't go together.
Oil and water.
Yeah, totally. Exactly right. And so over that period of time, we learnt how to do debt financing into all range of tech companies. So not just software, but software in particular. And as we went through, I accidentally funded a company on a revenue-based finance, essentially a proposition, and then we started to think, it's quite a nice, tidy style of structure for funding tech companies. And fast forward 7 years in, we wanted to be able to offer that option, and it's something that's offered from global non-bank lenders in US and UK and other markets, and bring it to New Zealand. And it was really important to us to do it under the BNZ brand, to mainstream it as well. And so it's our first ever explicit bank mandate to fund into pre-profit companies.
Right.
And we do that into software as a service, business-to-business companies. And broadly, to really simplify it, we fund up to 33% of annual recurring revenue for SaaS companies, software as a service companies, rather than funding against a profit measure such as EBITDA, EBIT, net profit, or whatever it may be. And so we also don't have any recourse to personal guarantees or personal assets outside of the company, which is actually quite a big thing for early stage companies. And we go right down to $500,000 of recurring revenue. So it's earlier than we've ever been able to do that style of funding. And so the idea is to try and both be more helpful, sharpen up the equity and other sources of capital markets, and to actually provide some meaningful funding early in SaaS company life cycles. So
it's upended like a centuries-long sensibility, that if you're a bank, you start funding something when you can tell that it's either started to turn a profit or it's definitely going to turn a profit pretty soon. But it's upended the game in that area. And I guess that's a hugely emboldening thing. It must be a hugely emboldening thing for smaller tech companies, the knowledge that you don't have to be absolutely in the black in order to walk into a bank with confidence that you're going to get a loan.
Yeah, so I agree. It's one of the primary objectives of that funding style is exactly for that purpose. And it's kind of interesting that uniquely that first bank mandate to go pre-profit has been for tech companies, given what I said around where we were 8 years ago, right? So if you didn't have assets you could see, feel and touch 8 years ago, very hard to get any form of funding. We've gone past that and to the point where you now go pre-profit for some companies.
It strikes me that tech is an industry, more so than many others, whose fortunes are linked quite closely with immigration settings and relatively narrow immigration settings in terms of getting people with very specialised skills into the country, because you need these people once you get to a certain stage, and difficult to grow them because it takes years and years and years and years of study to get to that point. Accurate characterisation, do you think?
Yes and no. So immigration's one alternative. So And lots of companies utilise the immigration settings and migrants in terms of their workforce. A lot of tech companies also employ people offshore. Having talent in market's a key thing. So one of those constraints to growth for the New Zealand tech companies that comes up again and again is that international connectivity, and also having staff, or senior staff in particular, that have been there and done it before and know the markets that they're entering into. So there's a real blend, and broadly I think the comment is that it is a global talent thing. So tech companies will look for the best talent they can afford wherever they may be, and then try and make it work as a bit of a rule of thumb.
And I guess that gets into, again, the recurring theme of this, which is, the astounding growth potential that is a consequence of the fact that this is truly borderless. If you come up with a really, really good idea, the right idea could be adopted by 7 billion people. It could be. It won't, but it could be, right?
Yeah. Actually identifying the best market to go to is big, right? So who is your actual market? Which niches within, inch wide, mile deep, which niches within the market are key to you, and where should you start? So that borderless thing is a thing, and if you can create your moat or create your defensible area or client base by being super large scale or being really good in a niche.
Do you ever see a thing happening with tech companies where maybe you have a person, you have a founder or a couple of founders who are very, very skilled, very clever, they develop a really good product, they hit a certain point where maybe your business skills become of greater import than your technical skills, which have gotten you to this kind of point. And that's the point maybe where you need a bit of advice or guidance or mentorship from someone who's been and done this before. Is that something that you see a bit in this kind of area?
So definitely is the short answer, and the longer answer is there's different scale points where that becomes more and more important. My personal view is that having someone with strong commercial, financial, business acumen as early as possible is very important. So one of those opportunities that sits in is that stakeholder and investor relations piece. So I talked about capital structuring earlier. So having someone who's au fait and familiar with how to source capital and present the business out to investors, and same with other stakeholders as well. So, and then you see in New Zealand market typically, and again this is an observation through BNZ lens, is that you've got a lot of advice and support in that really early stage, and then there's these inflection points or scale points where things get more complex. And so, when you go from 1 to 20 staff, you can get everyone around a table and have an all-hands meeting. When you get to 100 or 150 staff, it gets a bit harder. And then, as you get further and further up in that scale, then you might be cross-border and in different jurisdictions and trying to manage culture, and suddenly need processes and procedures and all the rest to bureaucracy, like a bank. but it's just, you see that all the time, and so one of those opportunities that we see is trying to support those companies and also trying to make sure that they're open-minded to chopping and changing or subbing talent around them in, whether that's an advisory board or on the executive staff. And thinking about the mix of those skills that you need at each of those scale points, and actually ahead of when you hit those scale points, so that you're organised for when you do.
What are you, as a banker, wanting to see from these firms when you're assessing their fortunes heading into the future? What are the things that are going to make you go, okay, these guys are on my list? Yeah,
it's a great question. So there's a few things, right? So even if I frame up how we look at businesses for any form of funding, it's character, cash flow, collateral. Those have a bit of bank vernacular to them, but characters, who's the team? What's their capability? What are their skill sets like? And who have they got surrounding them? And your cash flows runs on the board. You're tracking your recurring revenue growth and your average revenue per user, per client, churn ratios, all the rest. And we look at that momentum, right? And momentum's super interesting from that perspective. And then what cuts some of the best ones out from the pack is that collateral piece. And that's, do you understand the key ingredients and or recipe where you're growing the value in your business? And have you thought about how you're making sure that you own and control that value? So you're building something that's separate from the characters, right, if that makes sense. Yeah. And so you pick that up pretty early from founders. If they're organised and thinking long term, then generally they'll have an answer and it'll be articulate and well thought out. Again, we don't like uncertainty, and so if you're not organised with answers to those big 3Cs, then there's a whole range of uncertainty. But if you've got proof points and you can show things like you've understood your market, you understood the problem that you're solving, got some client traction, you got some runs on the board, and there's a bit of predictability around where the business is going and momentum, then yeah, that's for us.